So yesterday, a star was born. I created a video that covered nearly a dozen different financing options for rental real estate. What made this video so unique from many videos that you may have seen around the topic of rental real estate investing and financing options is I had a relatively unbiased perspective on gathering all of the different options that I gathered. Most other real estate investors that you'll see or content creators in the space have, experience in real estate investing or, whatever their angle is, but they're pretty married to maybe one or two different strategies that are available. It's not very common to run across a comprehensive guide of nearly a dozen different strategies. And the point of that is to hopefully open your eyes up to financing options that may be available right under your nose that you may not have known about. So today, we're going to cover our part 2 to that video. In yesterday's video, we pretty much brushed through, what each of these financing options were and a little bit about the framework of how they work and where you can find them and a little bit around who they may work for or what scenario they may work for. Today's video, the part 2 we're covering today, is going to be a little bit more of a deeper dive into the underwriting and the mechanics of these different financing strategies. I want you to know more about what it's going to take to be able to qualify or use these financial strategies in your real estate investing journey. I want you to be able to go in with at least a baseline understanding of what it's going to take to either qualify or, structure or, put these different financing options together. And we'll maybe even cover a little bit more about how to marry some of them together in this video. So before we get started, I want you to take a minute. If you like this kind of content, if you find value in it, I want you to like, comment, subscribe, support the channel so the channel can keep supporting you. This is JP, your financial architect, here to help you create your blueprint for prosperity. So let's get started. So yesterday we started out in the video covering private money as our first major financing option available in real estate, and quite honestly, one of the most popular ones. When it comes to the qualifying for private money, and again, just a quick recap from yesterday, private money is going to be money coming from a private individual or private entity, meaning that it's, could be that, somebody in the family, it could be a neighbor, it could be some, a club or a group that you belong to, or organization, people who may personally know you or do business with you that have excess capital or have capital they're looking to invest and are willing to potentially lend it to you in your real estate endeavors and adventures. So what does it look like to qualify, or what are the parameters for private money? Well, what's unique about private money is it's not really a qualification standard for you as a borrower. You're not going to, walk up to or sit down and have lunch, or have a meeting with a potential private money investor and bring them your credit report and your bank statements. That's not how that meeting's gonna go. In most cases, what you're gonna mostly be focusing on is your reputation and the deal type and what's in it for that investor. That's really going to be your qualification or your underwriting process in that engagement. It's going to be, what have you already done? What proof do you have that this is something that you're capable of doing successfully? What parameters or, construct is this, deal going to take? And what type of property, what type of investment strategy are you looking to employ? Private money investors are going to be looking for pretty much one major thing. How am I going to get my money back? How and when am I going to get my money back? And obviously they're going to be looking for a return, but they're looking for security. And you're going to provide that security to them by bringing them a quality deal, demonstrating that you have the skill set or the support behind you to properly and efficiently close this deal and get them their money back with the agreed upon return at agreed upon terms. So that's going to be your underwriting layout for private money. It's not really going to be about your credit score, how much capital you have. The intention of private money is for you to bring your skill set and match it with somebody else's money and desire to get a return on that money. That's pretty much it in a nutshell. Next, we're going to cover hard money. What does it look like to qualify or be qualified or in proper position for hard money? Hard money lenders, again, are going to be significantly more structured. These are also going to be private entities, but they're more likely to be family offices. They could be reasonable sized hedge funds. It's going to usually be, companies that have licensing. They are, full out business entities, and they have built parameters around what they're willing to lend their money on and the qualifications of the borrowers they're looking to work with. So you're going to have a little bit of a balancing act with hard money lenders. You will need to present your credit score or credit report, in this process. You're going to need to show a little bit of capital if you have any, or you're going to have to offset that by presenting a portfolio of successfully completed real estate deals. The gift of hard money is that they are leaning towards the quality of the deal and the property or properties that you're looking to do, conduct your deals with. So they're not going to be really as focused on you as a borrower. They're not going to be thumbing through W-2s and going through bank statements trying to figure out where this last deposit came from. They're going to be a little bit more focused on, okay, are you at least reasonably financially prudent? And if you're not, okay, let's just say you have a really subpar credit score, you have no capital, they may still work with you, but they're going to have tighter parameters and they're going to be expensive because they're going to be looking to offset the risk they're taking because you don't have a track record of being financially responsible, or you don't have a track record of successfully completing the type of deals you're looking to complete in this transaction. So you're going to need a quality deal, and you're going to need, you would be best served to have strong financials. If you have good credit and you have capital, then you're obviously going to be putting yourself in a much better position in negotiating a deal with a hard money lender for financing. But they will work with you if you have subprime credit, if you don't have a lot of capital or much capital at all. But again, they're going to be much more expensive and they're going to be really strict about the deal. They're also going to be really good with allowing you to combine other financing strategies. They're not banks. So their mindset is, look, we're willing to lend you potentially 70 or 80% on this property or 65% to take it down. If you can come up with a down payment, some funds to, support the rehab or, something of that nature, if you can put some skin in the game, then they're open to you, finding other strategies to come up with that money. Unlike traditional and standard banks, a lot of them, they're going to care where you get that extra capital from. So when it comes to hard money lenders, your credit will be a factor. If you have capital, your experience and the quality of the deal. That's going to be your 4 major parameters. I also mentioned self-directed IRAs in yesterday's video. Self-directed IRAs can be a phenomenal tool. This is not going to be an underwriting scenario for the most part. This is your own money. What you're going to end up doing is, again, you're going to have to work with a company that's going to structure that IRA by certain legislation and laws that are out there to allow you within a certain parameter to use that capital to invest in alternative assets. And in this conversation, we're referring to rental real estate. You're going to be using your own capital. So there's not going to be any credit requirements or additional down payment requirements. That's not how this goes. This is going to be very beneficial for those of you who have IRAs, at institutions or with brokerages, and it's sitting there and you're just kind of, really getting interested in other alternative investment options. If you have an IRA, could be a good way to go for you. Again, the caveat on the other side of that is the investment has to be held by that IRA and the earnings have to funnel back into that IRA. So technically you can't necessarily take that IRA, that self-directed IRA, and, go take down a property and that property basically, be in your name or some separate business entity name, and, the cash flow and all the benefits are coming back to you. It doesn't quite work that way. this is going to end up being a retirement vehicle for you. So you can acquire these properties while you're still younger or pre-retirement age, but you're not really going to be able to access that capital until after retirement age, which is 59 and a half at the time of this video. The next option that was discussed was 401ks, loans from your 401k. What are the parameters and terms for that? So the gift of this is, number one, it is not an underwriting process. You're not going to have to supply documentation or get your credit pulled to access a loan from your 401k. What you're basically going to be doing is borrowing from borrowing from the company holding the 401k, and the 401k is going to end up being collateral, and you're going to have a fixed interest rate and a fixed term. Again, most likely going to be single-digit interest rates, which is great. Your term is probably going to be somewhere between 3 and 5 years, which is, reasonable. It makes those payments pretty high, so it's not going to be the greatest long-term option. But if you're looking to just get in the game, take down a really good deal, or just jump out there to get started in your real estate investing journey, having a 401k, they will allow you to usually take around $50,000 or 50% of that 401k, whichever is lower is typically the common circumstances around at which you can borrow from it. And, that's pretty good down payment money. And in some markets still potentially going to be enough to maybe take down a whole property if you find a really good deal. But at minimum, it can be great down payment money and, or rehab money. And then you can use that to add value to a property, refinance out, and then pay the loan back. So 401k loans can be a great option. Local banks and credit unions. One of my personal favorites. I'm huge on relationship banking, and I'm probably going to do several videos diving into, different tactics with loans, real estate investing loans with local banks and credit unions. I feel like it's a really underrated area when it comes to financing options. But they are most likely going to be where you're going to go for your last, your final financing option, we'll call it. What I mean by that is most of these other options that we're covering today are going to be short-term options for you to just get into the deal, take it down, rehab it if you're going to do rehab work, and then secure the property, get a tenant in it, stabilize it, and then you're going to come to your local bank or credit union to get long-term fixed rate financing because they're going to have the most attractive terms and options. What does the underwriting process look like in this scenario? The underwriting process here is going to be stringent on you as a borrower and the property. This is the caveat, or what I always discuss is the trade-off to each tool or strategy that you're going to be employing. So with local banks and credit unions, they are going to care significantly about your personal credit, your personal financial track record, credit, capital, savings, banking relationship, where the money came from. And they're also going to scrutinize the property. It's going to have to pass inspections and appraisals. This is going to be something that you want to put yourself in proper position for, because if you can get over these hurdles for underwriting, then at that point in time, you're going to take down the most efficient form of financing available when it comes to your rental investment properties. Guaranteed. There's not many other or any other options really out there that for the long haul are going to have the most stable financing for your rental real estate. So you're really looking to graduate up to local banks and credit unions and, even larger banks, honestly. But local banks and credit unions are going to be the most flexible of banks. Not compared to all other financing options, but of banks, local banks and credit unions are going to be the most flexible. They're going to be most personable. They're going to be willing to sit down and get to know you and get to know your deal, and maybe even work it out where they can bend their parameters and guidelines to the type of properties and the type of deals they'll be open to, financing. So they are a great option, but definitely a full underwriting, definitely a full inspection and appraisal scenario on the property. Not the easiest option, but worth it when you can get there. The next one we discussed was owner financing. What does this look like? Owner financing is going to be a terrific option in the midst of the real estate deal where you find a really good property. The owner is, looking to get rid of the property. And that owner is flexible on how they are to be cashed out on that property. The beauty of it, benefits from an underwriting or qualification point of view, is going to be, yet again, most likely no credit is going to be involved. A good chance if you negotiate a property is not going to be much need for capital or any capital at all. And this is also going to be very similar to private money in its flexibility, because again, it's really going to break down to what works for that owner, the seller. Like if they're willing to take, long term, some sellers will take financing for the next 20 or 30 years. Could be a really attractive option. Some of them may want to do some kind of 3 or 5 year fixed option and then balloon out where you have to cash them out. There's all kind of different ways to negotiate this. You're just going to want to find the pinging point of the seller. What is it they're looking to accomplish? What return? Are they looking for their cash as soon as possible? Are they willing to take payments and take it as a retirement income, in the long run? What is it that seller is looking for? Once you figure that out, that financing option is extremely flexible. It's another scenario where you as a borrower aren't going to be scrutinized. It's going to be your negotiating skill set, your ability to add value to that deal for that seller or that owner to decide, okay, I'm willing to let you into the property with no money down on fixed payments. And they will likely, in some scenarios, take payments at a lower deficit from what the rental income is. That's the beauty of owner finance. And a lot of times those properties are paid off or paid down enough. The owner and the seller, may be retiring or just has something going on in their life where they just no longer have an interest in keeping the property. And, you have a significant delta between the rental income and what the owner financing payments require in terms required. So owner financing can be great. No strict underwriting circumstances, just a matter of the sweet science of negotiation and the magic, what's in it for me, for the seller. Next is going to be equity. Equity in your existing property. This is going to break out into about 3 different subcategories that we're going to run through really quickly. Equity in your property can be another phenomenal short or intermediate financing tool, possibly long-term, but in most cases short to intermediate for your rental real estate investing. There are tons of videos out on how to use HELOCs to buy rental properties. And HELOC stands for Home Equity Line of Credit for those who may be new. Equity out of your primary residence is going to be a phenomenal tool, but this is, yet again, from an underwriting perspective, you're going to have to go through a bank to tap into it in the vast majority of cases. This goes right back to our local bank and credit union conversation when it comes to underwriting. You're going to have a certain amount of equity in the property, and every institution is going to have its own parameters, but you're looking somewhere between, them doing a maximum loan to value, meaning the amount of money they will loan you versus the equity in that property of about 75 to 85, in some cases 90%. So example is if you have $100,000 of equity in your existing property, most banks will be willing to lend you somewhere between $75,000 and $90,000 against that equity. You're going to need full underwriting in the sense of your credit being pulled and having to be in great shape. You're going to need to have strong documentation, provable income, W-2 taxes. It's very close to taking out another mortgage. It's a second lien on the property in most cases, unless you're doing a cash out refinance, in which case you're replacing your existing loan and establishing a new primary loan. So home equity lines of credit, you're going to be basically creating a credit card from the equity on your property. It's going to be a revolving balance that you can borrow from, pay back, and reuse. It's going to have interest payment only options, usually the first 10 years or so. And then from that point on is, you're going to usually have to make standard principal and interest payments, but there's some, nuances to that. Something important about HELOCs. The interest rate is variable, and in the environment we're in now, where the prime rate is adjusting on a regular basis because the Fed funds rate is constantly increasing. I shot a video about this. Go back and look in the playlist and dig it up. So the interest payment, can fluctuate. You have to be careful with that. We're not in a fixed interest rate environment as far as, the rates being stable right now. So this option is something you got to be careful with. There are home equity loans. You can tap into that, check that option out at different institutions. That's more of a fixed payment as well. against the equity in the property and a second lien on the property still, full underwriting, cash out refinances. This is where you're going to replace the loan and take out the equity in a lump sum of cash or some portion of the equity in a lump sum of cash and restart your primary loan all over again. And this is yet again a full underwriting, full appraisal scenario. Next, we have peer-to-peer loans. This is another one that is, a great option for short-term take down a property, rehab it scenarios. This is going to be a great short-term option. Peer-to-peer loans are going to have a moderate underwriting process. You're going to need to have reasonable to good credit. And you're going to also want to be prepared to demonstrate, what you need the money for and possibly have to pitch, your idea to these investors. On average, these larger, stable platforms that offer peer-to-peer lending where you can go borrow from them, they are looking to find the most stable borrower, qualified borrower, so a solid income, solid credit. And you're probably not going to need stuff like tax returns and W-2s, but you're going to need pay stubs. You're going to need to have your credit pulled. And you're probably going to have to demonstrate what this money is for, where it's going. And, some of them may be leery or have flat out no-go zones on, the money going towards investing in real estate. So you'll have to navigate that if you're going to try this peer-to-peer route. But if you can find, a company, a platform, or an entity where they're a little flexible with that, they'll give you a business loan, but they're not going to want it to go to real estate in some scenarios. But you can figure out how to navigate that when you do your homework. But again, just from an underwriting perspective, you're looking at credit and income in that scenario. And then again, what is the project that you're working on that you need this income for? But it could be a great short-term option. Fixed rates, you usually can get $30,000 or $40,000 if you can qualify for that amount. So it can be a pretty decent lump sum of money. Our next option is also one that can be accessible to the everyday person, the everyday starter in their real estate investing journey for financing is personal loans, personal and business credit cards. Most of you who are, have been functioning in your financial lives probably have some experience with one or more of these products. Personal loans are a great short-term option as well. Your underwriting, we're going to consider that a moderate. You're going to need to demonstrate income, usually through pay stubs. Depending on your income type, you may have to provide tax return and documentation if you have like 1099 or commission income. If you have a W-2 job, most of the time pay stubs will suffice. Or some companies are kind of upgrading, or fintech companies are now plugging into your bank account and offering personal loans off of your income and not leaning on your credit as much. But most traditional banks and credit unions are going to want to pull your credit. They're going to want you to have reasonable credit. You can expect somewhere reasonable to be 640, 660 or higher. Ideally, the higher the better, because the lower your rate that they will qualify you for, the higher the interest rate you're going to have to pay. But, demonstration of income, credit, great short-term financing option when it comes to personal loans, because again, they're going to be fixed for, a term of time. So you can calculate taking down a property, getting, buying it, adding value, cash out, refine it out once it's stabilized and paying that loan off. Business credit cards and personal credit cards are going to be the same thing. In this scenario, you're going to have a little bit more flexibility because personal and business credit cards, most times than not, are going to go off of stated income. So you're not going to typically need to provide documentation. You need to be careful. There are financial audits and triggers depending on what you report, or if the bank just decides that they want you to prove your income. So you obviously don't want to go in there inflating or flat out lying about your income. You want to be as close to in the ballpark as possible. But again, it is stated, and this limits the documentation. It can be accessed to relatively quick capital, and you need to have reasonable credit to qualify for this. This is where it's going to come into play, having relationship banking and being able to qualify for these different credit cards, personal and business credit cards, by having established relationships. If not, you're going to want to make sure your credit is in a healthy enough position. But again, if it is, this can be a very quick and effective tool. Quick benefits and perks on personal credit cards and business credit cards is the ability to earn rewards points on the process of financing using this capital, and the ability to potentially not have to pay interest if you can get the job done fast enough. If you can find yourself a 0% interest credit card, ideally business credit cards are most attractive for this because most institutions, they won't pop up on your personal credit report like personal credit cards will, which limits your ability to use the entire limit available to you when it's on your personal report. So personal credit cards are a bit tough, but they can be used if it's a great deal and you think it's worth it. Business credit cards are most attractive here. There's plenty of content out there on business credit cards for real estate investing. But if you can get your hands on a 0% interest credit card or multiple of them and get the deal done before the term of that 0% interest runs out, then you can potentially have a win-win-win scenario. You can get the proper financing that you need, earn rewards points, build business credit, and also not pay a lick of interest if you time it properly. So this is another phenomenal option available to you. We're getting down to our last couple, life policies. So when we are referring to using life policies for leverage towards real estate investing, we're looking at one of the most complex and highest levels of life insurance to use for this to work. You're not going to go get your standard term policy or whole life policy and put some cash in it or pay in it over time and be able to take money out of it and go invest in real estate. This strategy is literally for one of the most hidden and complex forms of life insurance out there. Some people refer to as infinite banking, bank on yourself, velocity banking, all kind of different terms have cropped up over the years. This technique goes back very far. Some very wealthy people in this country have used life insurance policies to store their capital and scale their businesses. And as a matter of fact, a quick tip just to kind of open your mind up, actually one of the greatest assets that most large institutions in the world hold is life insurance policies. Crazy, right? But believe it or not, there's a lot of large institutions hold massive life insurance policies. So we're going to probably shoot several videos. I'm going to create a whole playlist around life insurance, believe it or not, because I want to give this the credit and the time that it deserves. But for now, you need to know that it's a phenomenal tool. If once you have it in place, you're going to basically be funding it yourself. And then once either with a lump sum or monthly payments, and once it's at a certain level and a little bit of time passes on it, you're able to borrow typically 90 to 100% of the capital in there without actually affecting the cash value of the policy. You're able to control the interest that you pay for the most part. Of course, the company, the life insurance policy company that's lending you money on this policy has a little bit of its own interest rate, but it's usually very minimal. And the rest of the interest payments actually go back into your cash value. So you're paying yourself back and you can control the term. Worst case scenario, heavens forbid, you pass away. The loan that you've taken out that may be outstanding simply comes out of the death benefit of the policy. So it's a really amazing tool, but it does definitely take some financial prowess to get in position to be able to create these policies and use them effectively on that level. Margin loans. Margin loans are going to be another great tool if you have a significant stock portfolio. If you have a brokerage or of some sort, you rolled over a 401k or some kind of retirement account over into a brokerage that you're holding, or you're just a general stock investor and you have a significant, stock portfolio, margin loans can be wonderful. Many platforms, banks and institutions, when they get to us, your portfolio gets to a certain size, and this is going to vary depending on what institution and company we're talking about. Sometimes as little as $10,000, you're allowed to take a margin loan. And in some cases, it has to be as far up as $150,000 or $200,000 or more, $300,000. But what this is basically going to be a low underwriting standard. You're not going to get your credit pulled at all. Your stock portfolio is going to be used as collateral. In most cases, it's going to be a line of credit offered to you where you can borrow a certain percentage. It's called a margin loan because there's a margin between the value of your portfolio and how much they'll lend you on it. And your portfolio, as we all know, if you're a stock investor, you are well aware that your stock portfolio can fluctuate daily. So you have to be very careful with making sure that you borrow an amount that is not too close to the top of the margin line that that company or institution is offering you, and your stock portfolio drops and taps that margin loan, they're going to call that loan in due. So basically, once the stock portfolio drops too close or too far below that margin that they have preset, the company sees that as a massive risk, and they're going to want their capital back quick. So you have to be very careful. But if you are in a stable position, you have a sizable portfolio, and the institution that you're working with is willing to give you a certain percentage, 40, 50, 60% of that portfolio, you're looking at a phenomenal low interest rate, flexible term, and a flexible use of capital. They don't really care much what you use the money for. The interest rates are usually single digits. And again, it's revolving, so you can put the money back, reuse it and recycle and move forward. So no credit needed, no real specifics on the deal you're trying to do. You don't have to worry about the property meeting certain criteria. Phenomenal tool. And this, concludes and covers our various financing options for rental real estate. Again, the goal with this has been to open your mind up to understand that most likely there's something available to you right under your nose that can help you get started in your real estate investing journey. Any investment strategy's top priority or top advantage is going to be time. The sooner you invest, the longer you hold that investment, usually the better off you're going to be. So these financing options, and the point and purpose of this video is to try to get you to open your mind and understand most likely you have a tool right under your nose, or you're pretty close to a tool that you can access to get started in this journey. So I hope this brought you guys a ton of value. We're gonna dive deep into many different options and many different tools on how to help get you started in your real estate investing journey, as well as other financial avenues to help you level up your wealth. I've really enjoyed my time with you guys. Stay tuned, stay focused, stay in motion. I can't wait to see y'all soon.